You did everything right. You got the visa. You got the job offer. You packed up and moved to Australia. And then, 6 months in, you get a letter, not from the ATO, from the IRS. Because here's what nobody tells Americans before they move. The United States is one of only 2 countries in the world that taxes its citizens on their worldwide income, no matter where they live. You can be sitting on a beach in Sydney, earning Australian dollars, paying Australian taxes. The IRS still wants a cut. And if you're also investing, building superannuation, or holding managed funds, the bill gets significantly more complicated than most people expect. This video walks you through exactly what those traps are, what they actually cost, and what you need to know before you land, not after. The United States practices what's called citizenship-based taxation. It means that as a U.S. citizen or green card holder, you are legally required to file a federal tax return every single year, regardless of where you live, regardless of where you earn, and regardless of whether you've already paid tax to another country. Australia, like most countries, taxes based on residency. The moment you become a tax resident of Australia, which happens after roughly 183 days of living there, the ATO taxes your worldwide income too. So you now have 2 tax authorities in 2 different countries, both with a legal claim on your income simultaneously. The U.S.-Australia Tax Treaty exists specifically to prevent you from being fully double taxed on the same income. And for basic salary income, it largely works. But the treaty has gaps, and those gaps are where American expats get hit. The Foreign Earned Income Exclusion, the FEIE, is the first tool most Americans reach for. For the 2025 tax year, it allows you to exclude up to $130,000 of foreign earned income from U.S. taxation. If your Australian salary converts below that threshold in U.S. dollars, you may owe the IRS nothing on your wages. It isn't a complete solution. The FEIE only covers earned income, wages, salaries, and self-employment income. It does not cover passive income. It does not cover investment returns. It does not cover capital gains. It does not cover dividends. And critically for Australia, it does not cover superannuation. An American earning 95,000 Australian dollars in Sydney, roughly 63,000 US dollars, can use the FEIE to wipe out the U.S. tax bill on wages entirely. But the moment that same person starts receiving investment income, holding managed funds, or accumulating super, the FEIE provides zero protection on those amounts. The alternative is the foreign tax credit, a $4 credit for taxes already paid to the ATO. Because Australia's tax rates are generally higher than U.S. rates, most expats with moderate to high incomes find the foreign tax credit eliminates the U.S. bill more effectively. But choosing between them requires careful calculation, and the wrong choice in 1 year can lock you into a less advantageous position going forward. Superannuation is Australia's mandatory retirement savings system. Your employer is legally required to contribute 12% of your salary into a super fund on your behalf for 2025 to 26. The ATO treats super contributions as tax-advantaged, taxed at just 15% inside the fund, and withdrawals in retirement are tax-free for most people. The IRS does not see it that way. How your super is taxed by the IRS depends entirely on what type of fund it is. If your employer uses a standard industry or retail super fund, the most common type, the IRS generally defers taxation until withdrawal. Manageable. But if you have a self-managed super fund, an SMSF, the IRS classifies it as a foreign grantor trust. That means all income generated inside that fund is taxable to you annually in the U.S., even if you haven't touched the money. You're required to file Form 3520 and Form 3520A every year to report it. Missing those forms carries penalties starting at $10,000 per violation. And many investment assets held inside super funds are classified by the IRS as PFICs, which brings us to the next trap. PFIC stands for Passive Foreign Investment Company. It's an IRS classification that applies to most non-U.S. managed funds, unit trusts, and ETFs, including many investment options inside Australian superannuation funds. The IRS created the PFIC regime to prevent Americans from sheltering money in foreign funds that defer taxes. The result is a punitive tax structure that catches most American expats completely off guard. Here's what it means in practice. If you hold investments classified as PFICs and you sell them, or if the fund makes distributions, the IRS taxes those gains at the highest marginal income tax rate, not the lower capital gains rate. On top of that, it applies an interest charge calculated back to when the gains first accrued. The FEIE provides zero protection against this. The foreign tax credit only partially offsets it, and Form 8621 must be filed for every PFIC you hold, every year, even if you received nothing from it. For an American in Australia who has simply been investing in standard Australian managed funds or index funds inside their super, which is what most financial advisors in Australia recommend, the PFIC rules can create a tax liability that significantly exceeds the actual return on those investments in some years. The way around it is to hold only U.S. domiciled ETFs and investment products, which are not classified as PFICs, but that requires restructuring your entire investment approach before you move. And most people only find this out after they've already been investing for years. Two reporting requirements sit on top of all of this, and both carry penalties completely separate from how much tax you owe. The first is FBAR, the Foreign Bank Account Report. If the total value of all your foreign financial accounts, including your Australian bank accounts and your superannuation, exceeds $10,000 at any point during the calendar year, you are legally required to file an FBAR with the U.S. Treasury, not the IRS. The Treasury. It's a separate filing with a separate deadline. The penalty for failing to file, up to $10,000 per violation for non-willful failure. For willful failure, meaning the IRS determines you knew and ignored it, penalties can reach $100,000 per violation or 50% of the account balance, whichever is higher. Criminal charges are possible in extreme cases. The second is FATCA. Under the Foreign Account Tax Compliance Act, Australian banks and financial institutions are already legally required to report account information for U.S. citizens directly to the IRS. This means the IRS knows about your Australian accounts, whether you report them or not. The reporting threshold for Form 8938 under FATCA starts at $200,000 in foreign assets for Americans living abroad. Here's the critical point. Not knowing about these requirements is not a legal defense. The IRS's Streamlined Foreign Offshore Procedures program exists for expats who genuinely weren't aware. It allows you to file 3 years of back returns and 6 years of FBARs to catch up, typically without severe penalties, provided the failure was non-willful. But that program requires you to act before the IRS comes to you, not after. Here is what this means if you are an American planning to move to Australia. Your wages can likely be protected from U.S. tax using the Foreign Owned Income Exclusion or the Foreign Tax Credit. For most salary earners, the U.S. tax bill on wages can be reduced to zero with proper planning. The complications come from everything that isn't wages. Superannuation, especially a self-managed fund, creates foreign trust reporting and potential annual taxation on fund earnings. Australian managed funds, ETFs, and most non-U.S. investment products are classified as PFICs, which carry punitive tax rates and annual filing requirements on Form 8621. Your Australian bank accounts and super balance are already being reported to the IRS by your Australian bank under FATCA. You are also separately required to self-report on FBAR if balances exceed $10,000. Two tax systems. 2 different fiscal years. Australia runs July to June. The U.S. runs January to December. Multiple forms. Penalties with no ceiling. This is manageable. Thousands of Americans live in Australia and handle it every year. But it requires planning before you move, not after the first letter arrives. Are you an American who's already made the move to Australia? And did any of this catch you off guard? Or are you still planning and running these numbers before you commit? Drop it in the comments. If there's a specific situation, a particular visa, a specific investment structure, or a question about super and the IRS, tell me. I'll cover it in a follow-up. If this gave you a clearer picture of what you're actually walking into, subscribe. This channel covers the financial reality of living in Australia, the numbers nobody puts in the brochure.